All right, let's dive in. He already introduced us, but I'll let everyone go through and say their names so you know who everyone is. I'm James Seyffart, Bloomberg Intelligence.
Pascal St-Jean, President and CEO of 3IQ.
I'm Andres Valencia, Executive Vice President of 21 Shares.
Drew Hill, President and Chief Legal Officer at Canary Capital.
Patrick Bush, Senior Research Analyst, VanEck.
Steve Scott, I'm in the sales team here at BitGo.
All right, so this morning, I was actually on my train right here when I got an alert there was a new ETF filing for crypto. And I opened it and I was like, man, this is really good timing. I was like, Canary's filing something new. And then I opened it again and really looked at it. And I was like, this is even better timing with the Marinade event later. So I guess, Drew, like, can you talk about like what the partnership exactly is and what's going on? And then we can get into some more nuanced situations here.
Yeah, so we have, amended an S1 for the Canary Marinade Solana ETF. I think it is a partnership that we view a staking provider as an essential service provider to any stake product. And I think you've heard a lot of panelists today. It's a kind of a throughput that I've noticed is, staking providers and validators. These are risk parties as it relates to an ETF issuer. We view it the same way we view a custodian. And so building a, robust capability with a staking provider partnership, we think is where the puck is going for the SEC. So we want to be ahead of it. We want to build institutional grade products, and we need institutional grade ready service providers. And that's how we view the Canary Marinade partnership.
So we're going to have overlap with the prior two panels as well with the regulatory and Michael Sunshine. But let's go to you, Steve. Can you just talk about, like, you're one of those custodians that he was just mentioning. Like, what is the relationship between you, like, holding a spot asset versus dealing with an asset that does staking and then a staking provider? It's like all these different layers. Can you just give us like a run through of like how this actually works on the back end? Because I feel like even people who understand this space, probably me included, have like, I don't really know the diagram of exactly where things are moving. So I just love to hear you explain it.
Sure. I think firstly, just when dealing with Marinade and dealing with Canary, it's super important that that combination is a differentiator to the marketplace. There's multiple ETFs launching. People are really looking for how they can differentiate their product, whether that is multi-custodial, fee-based, or extra APY through Marinade. So it's an exciting product. ETFs in general are a very straightforward product. Like it really is just a cash flow product and then buying Bitcoin, Solana, whatever the underlying asset is, and holding those assets. Where it gets tricky is we start to go down the staking road path. Now, previously in the other panels, I spoke about the two things that are really, driving that problem. And the main one is the staking and the unstaking. The unbonding is a problem in Solana at 2 days. ETFs work on a T1 basis for redemptions. So there's been a lot of work going into how they're going to fix this problem. I think with what Marinade's come up with both the Select product, which helps the KYC element, which is a big issue for a lot of these institutions, especially ETF providers who are publicly traded. And then you have this concept of the instant unstake, but doing it in a native fashion. That's really important because we're not going down the liquid token basis. So adding in an RFQ process is something that Ethereum or other chains could use as well. It's a very important step to really solving that redemption process.
And I guess with that RFQ process, theoretically, it would be, you're going to be able to get out. It might not necessarily be the most executable best price forever if there's like some huge demand on the load, but you're going to be able to make that redemption.
Yeah, I mean, I haven't been involved in the way that the actual RFQ process would work, but obviously there needs to be guardrails that there will be liquidity there. For that liquidity, it comes at a price, right? So if you have liquidity available to go into that and basically lend it for the period of 2 days, you're giving up staking rewards, right? So straight away, there's an opportunity cost for people that are not staking their assets at 8 to 10%. So it's going to add costs into the basis of the ETFs, but it's going to give investors significant upside in what they can get on their returns.
Yeah, and brings me back to like how ETFs work. Like everyone's worried about the liquidity, but like at the end of the day, you can get out even if they're trading at a discount. Let's go to Andres and Pascal here. You guys both have staking products. You have one of the, I think it is probably the largest staking product in the world. It's almost $1 billion at 21 shares. Can you just talk about exactly how that's working over there and how you found success, and just talk a little bit about the actual staking process that you guys are using in that ETF?
Yeah, of course. So ASOL was the first product I launched when I launched 21 shares 24 years ago. So as part of that, we're defining that operating model. We follow an operating model very similar to what was described in the Marinade process. It's very manual, but we do have to engage different counterparties and to basically optimize yield and also manage that liquidity on the primary market. So we do engage with different vendors. We do our KYC due diligence, and we're constantly monitoring these validators for performance against industry benchmarks. So we do actively reallocate assets through the creation and redemption process in order to optimize these yields across the ETP for issuers. And something important here to call out is when we promise easy access to crypto via an ETP vehicle, what investors really care about is that these operational flows are built in a way that's transparent and that they understand and that's predictable. So ensuring that operating model through these vendors is essentially how we can ensure that our product operates as needed.
Great. And then Pascal, I want you to get into like how you guys, so for those that don't know, in Canada just last month, we had a whole bunch of Solana ETFs. They're all doing staking. We can get into nuance there. But I also want to shout out 3IQ because everyone knows about Michael St-Jean's battle with Grayscale and the SEC down here. 3IQ went through a similar thing with the OSC up in Canada years before we went through it down here with the SEC. It sounds like you kind of went through a similar argumentative battle with the OSC over staking. Can you, one, just talk about that regulatory reaction with the OSC and what that was like? And then I want to hear about how you guys are structuring staking with your product.
100%. And so for us, our mission was always, we have three prongs in our strategy. And one is the ETFs, and particularly staking is a way to bring in more people into the space, and then staking to help secure the network. Because if we do not stake collectively and a lot of AUM comes into our products, we're not maximizing the security of the network, which is not fulfilling the mission that the Solana Foundation and other foundations are trying to do. So for us, after we got Ethereum out, we wanted to get other assets out. We had filed years ago for Solana as well as with staking, assuming that they would allow Solana before staking. But they actually said, you know what? We're not ready for other asset classes just yet. We want to learn more in terms of the growth of those protocols, but tell us more about staking. We were quite surprised. That was a 2-year journey. So ETPs and ETFs are different structures, different regulatory regimes. And because the way Canada is, we have a direct relationship with the regulators. We won the regulatory battle. And so we started the educational process. And the way Canada works right now is we don't have digital asset specific regulation. So you have to take the view of where things sit and bake it into existing regulation. So it's definitely not SEC lending, but that's how we got it through. Okay, that's how it's perceived in Canada. And so we were able to launch the first staked ETF 2 years ago with Ethereum. And so with Solana, when finally the futures came online and the regulators said we're open to Solana now, we wanted to make sure that we were winning the race. So right now we're the second largest product globally a month in. And the reason being is because of our active approach to staking. So like you said, others have copycatted the prospectus. They click Coinbase Cloud and click on staking. 3IQ stakes because we're the OGs in the space and we're super connected with different custodians and different validators. We optimize for staking percentage and yield to try to turn this not just into a very attractive retail product, but a very keen institutional. So today our AUM is half institutional and half retail. And so the way we do this now is essentially looking at weekends, validator yield, our institutional deal flows, understanding how long certain investors are going to stay in to try to maximize percentage of staking while working with custodians and others to abstract away some of these new innovations so that we could bake it into the to the products without getting the regulators confused in terms of how things function.
Great. And then, so when I looked at your stuff, one, the fees are all very low and a lot of people have waivers up there. Can you just talk about like what those fees actually look like from the staking percentage? So like there's a few key points that I paid attention to, and it goes back to kind of SEC lending. That's the way I kind of think about it, even though I know it's not the same. But like what percentage of your assets can you do some sort of staking, whether it's liquidity token staking or native staking? And how does that pass through to the expense ratio? What percentage of the yield from the staking are you passing on? I'd love to hear from both Andres and you, Pascal, because I know you're the two with the staking product.
So I'd like to talk about total return because fundamentally it's how it's going to function. So the way we look at it is our commitment to investors is the best performing Solana product in the market. And so in terms of total return. So that's a blend of how much percentage of the assets can be staked, how much we give back to the investors, and how much we keep. And so for us, if you look at, management fee, MER, so how do we squeeze the prices of our custodians and others and trying to be grateful to everyone, but how do we, negotiate prices down? And at the same time, we take a certain percentage in the back end, taking a risk with the investor. So right now, the average is about 30%, that across the Canadian side, but we stake much more because of the active management side. Now that will come down over time. And so fee compression will be real because we want to, guarantee sort of that outperformance. So that's a risk we're willing to take. And that's why as a business, we've evolved beyond just ETFs, because in the end, fast forward a few years from now, people were talking about the 3-year vision. I mean, investors will expect the majority of the staked assets back. If not, they're going to find different ways of doing it.
Which ironically is basically what happened with securities lending in the ETF space. You lend out your underlying shares, and in some cases, these really cheap funds actually get more yield than they're charging an expense ratio.
Could I just add on the
Yeah.
spread side of things? The ETFs have definitely pushed the custody side of revenues lower. There's obviously before we had Bitcoin, where Grayscale was pricing their business, right, was quite wide. That obviously came down. They were doing 0 at one stage for the first 6 months. Some BTC partners. So custody's definitely been compressed. It's an area where the assets have grown, so we've been able to bring those down and sort of work on volume rather than smaller amounts of assets.
Yeah, some of those ETFs are still 0. VanEck's HODL ticker for Bitcoin is actually still 0 right now.
That's right now. It's for the next year. I mean, the biggest thing is if you go back to the Bitcoin filing, overnight, everyone was changing their expense ratios lower and lower and lower. And I don't see how a similar dynamic doesn't play out, right? There was 10 issuers with that. This one, there's probably going to be 5 or 6. If you look at our Bitcoin ETP in Europe 18 months ago, can anyone guess what the expense ratio was?
I mean, I can.
Well, besides the expert, it was 150 basis points. Right now, it's about 100. And so that just tells you how competitive the dynamic it is in the United States and probably what we'll see. One thing that I probably should mention, but I think is pretty interesting, will be how MEV plays into this dynamic. That's like a yield differentiator. And one of the components of the secret sauces of the validator complex is that often they have OCAs or off-chain agreements with market makers, people who want to be first in line of the queue for a trade. And so monetizing those might be a key differentiating factor going forward if you can wrangle those validators and make sure they're properly remitting their funds. Like, for example, Gito just actually tried solving this problem with an on-chain solution. We'll see if it actually works, but we're going to be monitoring that very closely.
I think total expense ratio is the exact right way to think about these products. And without, committing any antitrust violations here with all these issuers on stage, I expect the next wave of crypto ETFs to be more sponsor friendly from a pricing standpoint.
Yeah, I mean,
There's room for the custodians to make some money on it.
I think one thing about ETFs, which is a little different, is there's not trade volume. It obviously usually goes to liquidity houses for that. So on a custodian side, it really does come down to custody fees only. But with staking, all of a sudden that can give us a bump up and help on the revenue side. So
yeah, we looked at what happened with the Bitcoin ETFs, and even happened with Ethereum ETFs to a lesser extent. Like it was like years of price war that we're used to seeing in our ETF world happening like overnight. It was like so accelerated, it was insane. Which I guess is kind of what the space is doing. It's accelerating so fast. Drew, I want to talk a little bit about these ETFs might get approved in the US specifically without having staking. Like that's a distinct possibility because some of the regulatory issues we were talking about, the Treasury and IRS rules, even if the SEC is keen to allow it, there's still questions about like what the tax situation will be. Our team, we were pretty bearish on the Ethereum ETF demand, and we weren't bearish enough, essentially, despite getting a lot of flack from ETH and DeFi community. But I know Steve McClurg, your CEO at Canary, was at Valkyrie, and they were filing, and they didn't end up launching. And I asked him why, and he basically said, without staking, we don't see a point to even do this. So can you just talk about like what demand you think there will be for these things, and how much, if staking isn't allowed, how much will that hit demand from your guys' point of view? At least initially. I think eventually it'll get sorted, but whether or not it happens immediately is a different question.
Yeah, I mean, from where we sit, we want to push the envelope on product development, and the next frontier is staking. And these to me are not compelling products without staking in them. So that was a decision that we made at Valkyrie as well. We did not launch an ETH ETF because there was no staking. I would take the same approach here to Sol. Like if these get approved without staking, I don't think Canary would be one of the issuers.
Can you guys comment? Like, you guys are also issuers. Like, what do you think about this, Andres?
I would agree with that. I think that staking is a feature of the blockchain, and it's something that investors are 100% interested in. We've seen our products grow, especially the ones with staking, at a faster pace over the past couple of years. That being said, though, like, you do want to be in the market, especially for like us as 21 shares. It just comes back to the question, like, what price do you want to buy into this blockchain at, right? So if you do have the ability to buy Ethereum at, call it $100, $300 without staking, like, would you want that exposure?
We've taken a bit of a different approach. We've pivoted over the years to be a little more institutional because understanding that the bigger players are coming into the space. And so staking was always a key component for us to make it attractive to earn institutional tickets, not just retail, because if not, you're ending up competing with 10 issuers, which is great for the end investor, but very difficult for a smaller competitor to come in. And we've also started, how we play the institutional game besides direct allocation is also supporting others who want to catch up. And so you'll be seeing 3IQ coming up this year with a lot of big names, some of the banks and others that want to catch up into the game. And staking is uber critical for them to be attracted to want to launch products. So for us, without staking, which is why we worked for 2 years to get it approved, and we're excited to see what happens in the US. Without that, investor demand is lower, institutional demand is lower, and you're not going to see others jump into the game as well. And so you end up being a disservice for the community.
Patrick, I'm going to go to you. VanEck, you also have ETFs in Europe. You have ETFs here, obviously, in the US. But you guys also are actively managing different products, private vehicles, and you even have new actively managed ETF, which I know you're involved in. So I guess from your point of view, you're somebody that's might even be, one, launching these products, but you'll also be looking at potentially investing in them. Can you talk about like what things you'll be looking for, how you'll be evaluating potential ETFs? Like when we have Ethereum staking and Solana staking, are there nuances between what you'll be looking at? What are you going to be focused on if you're going to say, take your actively managed crypto ETF and go into one of these products?
No, I think the most important thing will be, one, staking and what the competition is. So if you think about even Solana, there's already equivalent publicly traded products that are leveraged, and in some cases maybe better. So you have like Sol Strategies, you have DeFi Development Corporation, which if you guys haven't been watching, are up roughly 1,000% plus in the past few weeks. And so you have this ability to get recursive leverage similar to what Saylor is doing in some of these things. So when we think about like what's our exposure and managing that, it's going to be how bullish we are in the market and the volatility profile we want to carry going forward. So what we look is that these ETF products might be a way to like pare down risk more than anything else, or bring it back up.
I just add on that. I think over the last month, the uptick that we've seen in the corporate treasury space of Solana has been really out of nowhere. You look at it, obviously people have been spinning up on the Bitcoin side. It's very prevalent, but it's really moving into Solana now. There's been multiple announcements about $500 million deals being done. We've seen a lot of that flow. We were the custodian for the FTX estate assets. So we helped take on those assets. A lot of those assets are locked. There's a lot of transactions happening in that space where people are trying to accumulate large size Solana and really build for the future, not just for a trading strategy. So I would just say it's been a real shift over the last month or so in that Solana space for the corporate world.
Yeah, I would say I thought when we got the Bitcoin ETF specifically, it would diminish some of the demand for, strategy. I was like, it's people are using it as a workaround. It's definitely what's happening with these other products. There's other countries that don't allow you to invest in this space. But I mean, if anything, it's kind of been an accelerant to the demand for those types of products. I don't know if the rest of you guys have any thoughts on like the Sol Strategies of the world and the corporate treasuries of like what that will do and how, like as ETF issuers, do you see them as competitors? Like, how do you think about it?
I need more than 5 minutes to talk about this one, but Saylor's one of a kind, of course, and that vehicle's got a lot of liquidity and attracting different types of institutional capital. We're seeing a rush of Solana sort of treasuries as well as Bitcoin globally, particularly in regions that were there. Now, if you look in Canada, when the ETFs launched, and Grayscale wasn't yet an ETF, it did go from a premium to a discount. The same thing happened after we announced our approval. Our ETF Sol Strategies dropped 80%. Now they're turning that into a real business. They're staking providers. There are other things that a Bitcoin treasury cannot do. So, and we know them well, and the stock has rebounded. But I think for those who are just looking to accumulate and not turn that into a real business, are going to suffer as more and more ETFs, become prevalent globally.
You have any thoughts, Andres?
I agree. I think there's a concept of institutional investors wanting security rails, right? So the more guardrails they have in terms of laws that are kind of protecting investors, you'll see capital be attracted to those vehicles instead. So as you said, as those ETF vehicles launch, you'll see capital be moved to the institutional wrappers.
And Drew, go ahead. I was going to say, you guys also run a hedge fund. That's primarily what you're doing right now. You filed for a lot of ETFs, including a Pengu ETF. But like, I'm just curious to like, how do you think about this space when you're comparing these, corporate treasury products, whether it's MicroStrategy versus a Bitcoin ETF or Sol Strategies versus a potential Sol staking ETF? Are you guys using these things in your hedge fund? I don't know how much you can talk about what you're doing in a private vehicle, but I'm just curious to hear, because both you and Patrick have this kind of dual side of things where you're investing in this space actively, but you're also launching passive products.
I think lucky for everyone in the fund that I'm not a PM, so I don't have a direct answer on that one. But these other products are really reg arbs. That's why they start out, and they're taking full advantage of capital markets, right? They had the ability to leverage balance sheets, the ability to add, just layer on. It also ends up being a meme unto itself. Like there's no way to escape it at this point. So it's not a rational basis investment. So it would be more of a momentum swing if you're going to be looking at, and it's not for the faint of heart, just like the rest of crypto.
Patrick, you wanted to say something?
No, I wanted to say something about what these ETFs might do to something like a MicroStrategy. So typically people associate the premium of MicroStrategy, the premium of its MNAV to its equity. Usually it's a multiple. Right now it's around for like 2. Usually associate with that with like speculative demand. That's partly correct. The other part of that is the fact that it's volatile and it feeds in and of itself. It's recursive. So the idea is that if you decompose MicroStrategy into Bitcoin holdings, the underlying stock, and the premium contributes like roughly 90% of the volatility. And so that's important because the premium exists because it's kind of a bet that MicroStrategy can continue to finance its purchases of Bitcoin. And it's recursive because they finance these purchases by selling vol cheaply through convertible bonds and through the equities, which are then go and they trade them against. So specifically arbitrageurs trade them against options and other products. So the idea is that if you start getting people who are more interested in these ETFs than MicroStrategy, that may drive down the entire volatility of the space and cause like volatility heat up for the premium. So if that volatility starts decaying, then they can probably stop raising as much money, and you see that premium might come in slowly over time. So that's like one of the risks or one of the positive sides that these ETFs might push for MicroStrategy.
All right, so we're under 2 minutes, so I'm going to go to each one of you with this question. But the one thing that a lot of people want to know here is like, how much demand is this going to create for Solana? And like I mentioned, that was the number one thing people cared about for the Bitcoin ETFs. Same thing with the Ethereum ETFs. The Ethereum ETFs have gotten like 10% of the flows less than what Bitcoin did. I guess I'm curious what you don't have to throw out numbers, but I'm just curious what the percentage ratio you think would be to something like the Ethereum ETFs or the Bitcoin ETFs. And how much do you think potentially not having staking at launch would impact the demand?
I'm happy to go first on just real quick because I want to let everyone else to speak. But in Canada, when we launched when Carrefours were on, the markets were in the dumps, and we weren't expecting much, and we were actually blown away by the demand. Staking played a massive role with that. So I think that's my key takeaway. If staking is activated and Solana launches, I think you're going to see good demand. I'll let everyone else talk about percentage-wise. If it's not, I think we're going to see similar reactions to Ethereum.
I would agree. I mean, I don't have a percentage to throw out there, just to be conservative, but I would expect staking to play quite a significant role here.
5% of market cap, maybe the total wallet.
I'll say that if you look at the MNAVs of the Solana strategies and the ones that are replicating Sailors, they're at a multiple to what you see of MicroStrategy. So if that's an indicator for demand, it could be pretty high, like 20%.
And I'd just say an 8% returning asset on APY with the way it's been performing and the popularity, I think it would be fairly successful on its launch.
Yeah, I mean, having an ETF both on the Ethereum and Solana side, and not being able to off staking is like having cash and putting it under your mattress, right? Like you can't actually partake in what's going on. You're not getting yield. You're not investing. The only people that are going to invest in that are people that can't get it natively, in my point of view. I guess that's all we have for time. Thank you, everyone, and we'll be around.